Hi there, I'm Stan the Annuity Man. Welcome live in the morning. I've got my cup of coffee, so I'm going to be sipping that. That's coffee cup number 2, but it's a very large cup. So I'm ready to roll. And I'm looking forward to answering all the questions. If you've been on these before, it's an absolute free for all. I read the questions out, I answer them factually. The only thing I'm going to ask up front is no tax questions. I know that I look like a CPA and a tax lawyer, but I am not. So please don't ask any tax questions because I will defer it to the CPAs and the tax lawyers because they're the only ones legally that can answer that. The other thing too is if you are an agent or an advisor or a master of the universe out there that's on this program, please do not waste our time with your questions. You can contact me one-on-one if you would like. Love you, mean it, but this is for consumers only. Please be respectful of that. And with that being said, let's kind of jump in a little bit. I'm very pleased and honored to have my CEO on this in the background on the call, and also my marketing director, both dynamic ladies that run the Annuity Man on a day-to-day basis from our main offices in Las Vegas, Nevada, our operations center. And I'm coming to you this morning from sunny, humid Florida, the beaches of Florida. But yeah, so put in the questions. I'm going to go through a couple things. Let's pull up the site. One of my favorite sites of all time, and I hope it is yours as well. If you could do that, producer. Let's see what we got there. There you go. There's the site. And if you haven't been there, it's theannuityman.com. It is pro-consumer. You can book a call with me. Typically, well, it's not always with me, but it can be with me. But, we have annuity experts as well. But hopefully you can get me and one-on-one. If not, you're going to have someone else smarter than me. So you can book a call. It's a 30-minute call. We're going to listen. It's not some close, hammer. We're going to listen, put together a customized plan for you. We're actually going to tell you if you don't need an annuity. You can also use our calculators. If you go to that, we have all kinds of calculators, unique, immediate annuities, deferred income annuities, QLACs, index annuity quotes. You can get income rider quotes. You can also go to our live MIGA feed and take a look at that. And then also, too, here's the live mic thing. Maybe just put in, so just click, there's Alabama. We like Alabama, but you click down your state, your years, and you're going to see the best rates in the country. And MIGA rates have been rising, et cetera. And also, too, just for, if you haven't gotten the books, you might want to consider it because the consultants are now whispering in my ear that we don't need to be giving these things away anymore. Right now, if you sign up for the books, we're going to send hard copies to you in a Willy Wonka gold foil mailer. And for the people out there that's received it, they're like, yeah, it actually is gold foil. But there will come a day that they're going to convince me somehow that I shouldn't be spending all this money sending books out. But I don't know. Maybe. We'll see. But you might want to sign up for it because eventually I think they're going to win out. A lot happening, as you well know. Markets, crypto, war, midterms, hearings, interest rates, inflation, gas prices. There's a lot happening out there. And I appreciate you taking the time to look at annuities in general. As you know, if you've followed me at all and gone to my Stan the Annuity Man YouTube channel or listened to my podcast, Fund with Annuities podcast, if you haven't heard that, every Tuesday comes out on all major podcast platforms. And we have some phenomenal guests. We don't really talk about annuities. It's primarily about what the expert has in mind. A lot of it's market driven, a lot of it's Medicare or Social Security and things like that. So, I encourage you to do that. And we put out a lot of content. And the reason I do that is I want to educate everyone out there on annuities so you can make a good informed decision on your terms and on your time frame. One thing I want to point out that is kind of new, and if you got the newsletter this morning in your email box, I talked about interest rates and lifetime income in the future. Now, currently, and please put your questions, I will get to the questions, but currently, when I talk about lifetime income, and you say, okay, Stan, I'll ask 2 questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? And if your answer to the first question is, I want lifetime income, and the answer to the second question is, I need it to start in the future, there are 2 packaged products that do that. One's a deferred income annuity, which is an immediate annuity that you defer, and the other is an income rider attached at the time of application to typically a variable or indexed annuity. The contractual guarantees historically on the index annuity are higher, so that's what we look at. And I don't sell variable annuities, nothing against them. I just don't sell anything that goes down. So those are the two income later type products that are out there. But I have a third one that we're using, and I'm promoting just because it's pro-consumer. It strips out all fees. It's very, 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 very low commission, which is the reason you'll never see it at the Bad Chicken Dinner Seminar, expensive steak dinner seminar, or whatever being promoted locally on the radio show. But I like it. It's a MIGA to SPIA strategy, meaning you're buying a multi-year guarantee annuity with a guaranteed interest rate for a specific period of time. And then at the time you need income, or at the end of the duration of that multi-year guarantee annuity, we have that carrier quote an immediate annuity payout. And then we go shop all immediate annuity carriers for lifetime income stream payout. And we choose the highest contractual guarantee. Typically it's an outside vendor or an outside carrier. And we do a direct transfer, non-taxable event from the MIGA to the SPIA. And it's a way to, in my opinion, kind of get the best of both worlds. You have control of the asset. You don't have to turn on the income stream at the end of the duration. But if you do, then we go shop for the highest contractual guarantees at that time. And you're also getting the interest rate levels at that time. You can also walk away and say, hey, I don't want to do that anymore. But MIGA to SPIA. So give you an example. Let's just say you said, Stan, I need income in 5 years. What we quote income riders, we would quote deferred income annuities. And I'd also say, you might want to consider buying a multi-year guarantee annuity. In a lot of states right now, you can get over 4%. A lot of states. You can, again, go to my MIGA feed and you can pull up state and the guarantee. It's not all the same because fixed annuities are approved at the state level. So each state's different. But at the end of the 5 years, we know what you're going to get because you're going to get that percentage for that 5-year time period. And then we can go shop immediate annuities at that time. People are always asking me, hey, Stan, what do we do with rising interest rates? How do we combat that? First of all, we can ladder MIGAs and hopefully catch rising interest rates. But MIGA to SPIA is a good strategy. But let me get specific, and there's some questions that are coming up that I'm going to get to. But one more thing, and I think this is very important, because people are asking me all the time, hey, Stan, should I wait for the Fed meeting coming up? What should I do? I think at a minimum, and the sales gods are going to look down upon me and say, Stan, what are you doing? I'm telling the truth, okay? But if I'm you and I have to put myself in your situation as acting as a fiduciary, which means putting your best interest at first, which, in my opinion, all advisors should do automatically and voluntarily, but for whatever reason they don't, but I do. I would wait until the June Fed meeting for sure, and maybe the July Fed meeting. So you're saying, wait a minute, well, I don't want to buy it now. I want to do it now. Stan, well, let's do it now. That's fine, and we can talk about it. But if you had the patience to wait to at least the June Fed meeting, because I read something just recently overnight that they're talking about not just 50 basis points, but 75 basis points, 0.75% raised in June, let's hope, right? Or even more in July. They're going to have to do something. Powell is going to have to do something. The Fed is going to have to do something. Now, the markets are going to get hit by that a little bit, as we all know. Crypto is going to get hit by that. This is going to be an interesting time period, but my job is to find the highest contractual guarantee for you, shopping all carriers for that highest contractual guarantee. And if I can, as they say in the South, squeeze oil out of a brick and squeeze as much yield as humanly possible, and we have to wait 1 week, 2 weeks, or 3 weeks, or 4 weeks to do that, then that's what we are going to do, because I want you as a long-term client. I want you here for a long time, and I want you to understand that I am making these recommendations, these calls based on 30 years of experience and trying to figure out the best way to put you in a contractual guarantee. So that's kind of what's happening right now. It's a very interesting time to be in my business. Carriers are coming out with very, very high interest rates to attract premium. That's fine. I think that's out of whack, we're going to go get it. I think right now, if you said, Stan, what's the sweet spot duration for, say, MIGAs? In my opinion, it's 3 years. Right now, it's a 3-year time period. Doesn't mean you can't buy a 5-year or a 6-year, but 3 years is kind of the sweet spot. And remember also, if we're quoting lifetime income, SPIAs, DIAs, QLACs, those type of things, income riders, all lifetime income from annuities is a combination of return of principal plus interest. Now, interest rates do play a secondary pricing role, but the primary pricing role that drives the train is your life expectancy at the time you take the payments, or life expectancies at joint. So, the older you are, the higher the payment, like Social Security. So I'm going to take a sip of coffee, very large sip, and then we're going to jump into the questions. I'm going to read them out. So go ahead and put them up, director. And here we go. From Roy's place, which I'm assuming is a very happy place, Roy. I have 178,000 from a 401k. He's 57. I'm interested in an annuity versus a CD. Right there, we're talking about multi-year guarantee annuities, not indexed annuities. I'm not down on indexed annuities. We probably sell more than anybody out there. We just use them as a delivery system for the income rider guarantees. The reason that we default to the MIGAs is we can do them short term. And I think in this environment, it's very important to lock in money short term. Index annuities typically are a 7 to 10 year lock in. They do have shorter term durations, but they're not good products in my opinion. So annuities are the thing now due in the market. So I want to invest until I'm 60 with this amount. So in essence, I mean, you're buying a 3-year MIGA. And so you're doing a 3-year MIGA, and at the end of the 3 years, you can do it IRA, non-IRA, Roth IRA, any account. But at the end of the 3 years, you can take your money. We can transfer it back to the account it came from, if it was an IRA or something like that, or we can convert it to a lifetime income stream. Just remember, at age 57, if you're using non-IRA assets, like a non-qualified asset, you have to hold that asset until 59 and a half in order to, and not take any money out before that 59 and a half in order to not incur IRS penalties. So that's something we certainly will cover. But I think yours is a pretty simple solution, is we will do a direct transfer from the 401k to the annuity company, non-taxable event. The 3-year duration is probably the best for you, in my opinion. And that way you're going to protect the principal. You're not going to pay any fees whatsoever. And then you're going to have full control of the asset. The interest is going to compound. And at the end of the term, you have the full control of what's going to happen. Now, obviously, our team is going to take care of all the paperwork from start to finish, and we will be in touch 60 to 90 days before that duration to find out what you want to do. And then we will take care of that as well. We have the best administrative team on the planet, people that are already clients on here. They're nodding their heads if you can hear that. They're fantastic. So the experience of you doing this paperwork, we get in the weeds for you. We just keep you up to speed on the process. And at the end of the process, you're going to get a policy in the mail, hard copy you can hold in your hands. You're going to have online access with the carrier, and you're going to get an annual hard copy statement from the carrier as well. So next question.
Just a little comment here, because I had this come up this week.
The voice of the goddess.
God. If you're talking 401k money, please keep in mind most 401ks restrict it to being separated from service. So whether you are 57, 62, whatever it is, you can know most companies you no longer are working there in order to move it. If you're still working there most of the time, they won't let you.
Very good point. That voice from on high is Leah Brandt. She is the CEO and Director of Operations of the Annuity Man LLC, one of the best moves I've ever made. She's very smart. She has almost 30 years in the business. She's seen it all, done it all, and forgotten more than most people will ever know. So administratively, she oversees the team of people that do the paperwork. And there are times we're so swamped that she even has to get back in the game and do the paperwork too. So that's it. Next question. It's from Mark Campbell. Approximately 130,000 from selling a second home, 55, want to retire and kind of work part-time in 3 to 4 years. Would a MIGA ladder be a good idea to fund health insurance? I don't know about that. I think it's a good way to protect principal, and get a guaranteed interest rate. To fund health insurance, maybe from 59 to 65, because you could peel off the interest, not touch the principal. Most MIGAs allow you to do that. Not all, but most. We could find those ones for you. And then you could just peel off the interest, not touch the principal, and fund the health insurance ongoing, and then just keep rolling that MIGA ladder, hopefully to attach yourself to higher rates, still peeling off the interest to pay that health insurance premium. I think that's a good idea, Mark. It's something obviously we need to talk about a little bit more in detail, but once again, my team would take care of all of that. If you said, Stan, I want to do this and I want to peel off interest to pay the health, we would coordinate all of that so that interest would be coming to you. Once again, you can use any account type for that. Next question. Ted S., I've noticed many MIGAs and FIAs are labeled not available in New York in the fine print at the end of the carrier brochures. Yes, let's talk about that real quick. And is this a warning sign that a particular annuity is a good chance of being sketchy? No, it's not, Ted. Actually, it's a warning sign that in my opinion, that the New York Department of Financial Services they're just very restrictive on who they allow in, and it makes no sense. It just absolutely makes no sense to me, because they're supposed to be pro-consumer. So I think you're reading into it wrong, in my opinion. The New Yorks and New Jerseys and Oregons, those type of states are blue states. I'm not political, so don't read anything into that. But the blue states, a lot of them, not all of them, are very, very restrictive on what carriers are allowed in, what types of products are allowed in. Give you a good example, their income riders attached to index annuities are very, very popular. Some great carriers that are offering them, etc. But New York pretty much doesn't allow, they barely allow any of those in, which makes absolutely no sense, because people need income in the future, and income riders are a contractually guaranteed way to do that. Same thing kind of goes with MIGAs. They just are very restrictive. Like, for instance, if you want to go to my site and do a really interesting test, do the MIGA feed and then put in 3-year duration, and then do New York, and then do 3-year duration, do Texas or Florida. It's night and day. And you see A+ carriers and A-rated carriers that are in Texas that aren't in New York. Makes no sense. I have been, from a distance, kind of encouraging New York to be a little bit more pro-consumer, but I don't think they're listening to me yet. But it's kind of sad because there's such limited offerings in the state of New York. Next question.
I'll just add something in here.
Please, yes.
Being in the industry, for working in insurance companies, an insurance company has to have a location in New York in order to offer products.
That's good. That's a good point. I was going to mention that, but I didn't want to get in the weeds. I think you're right. So let's just look at that example. Thank you, Leah. If an A-rated carrier or A+ rated carrier who's solid, they have to make a decision. Do we open an office, a physical office in New York, in the state of New York? Because that's what it takes. It's a big barrier. That's a big hurdle. And a lot of these companies just punt and say, no, forget it. Next, what's the typical surrender charge fee for canceling a 3-year MIGA or 5-year? It's predatory. Time Creator. Love that. I love that name. Let's just give an example, and it's different with each carrier and each product, but let's just take a 3-year. A lot of times the surrender charge year 1 is 9%, surrender charge year 2 is 8%, surrender charge year 3 is 7%. And that means if you pivot and say, send me all the money back, Stan, I don't want to do this anymore, it's predatory in my opinion, those surrender charge penalties. However, if liquidity is an issue, then we're always going to say, let's choose one that you can either peel off interest or get out 10% annually. On the site, on the MIGA feed, you'll see those provisions listed that they'll allow you to take money out, etc. But that's the reason that when you buy annuities, period, any type, including MIGAs, they need to be in proportion and allocated properly. Obviously, me and my team of annuity experts know that. We also know that you need to be very careful not to put too much money in annuities. The annuity industry kind of frowns upon you putting more than 50% of your investable assets in annuities. Can we put a little bit more if you give me the case and we use that bullet to go to the carrier? Yes, but in a perfect world, you should not be putting more than that. But they are predatory. So when you go into a multi-year guarantee annuity contract, whether it's a 2-year, 3-year, 4-year, 5-year, 6-year, you need to go into it knowing that you're most likely not going to liquidate it in full, but you are just going to access the liquidity provisions that you know about going in. David C. with a nice, I think that's a 3-wheel motorcycle. Very nice. Hey, Stan, will interest rates go up affect my index annuity? Possibly. Typically, yes. You'll see with index annuities, and if you follow me a little bit, I really hate how index annuities are promoted. I hate that agents talk about market upside with no downside and market participation. It's garbage. These are CD products, and they typically get that 2 to 4% return historically over the life of the annuity. Can you get more one year than the other? Yes, but the blended return is that 2 to 4%. But with that being said, you're going to see caps and spreads and participation rates go up. which means there is more potential for you to lock in more, the gains on that contract anniversary date. But I want you to just get your expectations in line with the contractual realities of indexed annuities. They're not market return products. I hope you get that on some of the years that you have, but they're just not. And in my opinion, you should be buying multi-year guarantee annuities for accumulation instead of indexed annuities, and keeping them shorter term instead of locking something in for 7 to 10 years. There are times that makes sense, but those are specific, customized times that we need to talk about. So next question. Time creator, what's the minimum and maximum for a 3-year MIGA? It depends on if you go to my site, in fact, producer, can we do that? Can we go to the site and let's just pull it up and let's show this real quick, since we're getting a lot of MIGA questions. And just, pull whatever, pull Texas, because I'm not in Texas, but I like Austin because it has good music venues. And that's the reason. So let's just do 3. Okay. So let's go to the 3-year. Okay. Scroll it down. And that's how you pull it on my site, and you don't have to sign up. You can just look. But if you look at the 4th column of minimum premium, okay, some allow as little as 20, go down. Some is 250, some's 100, right? Minimums. And then if you look to the columns to the right, free withdrawal year 1, free withdrawal year 2 plus, you see that some don't allow it, some do on 2nd year, some do just take interest out. Go to the 5th one down, American National, they allow you to take 10% out day 1. So it's all different. And that's the reason that I represent pretty much every carrier out there. These are commodity type products. None is better than the other. It just comes down to the liquidity provisions that you need. A lot of people say, hey, Stan, I don't plan on taking any of this money out during the duration. Let's just get the highest contractual guarantee. I don't need the liquidity. A lot of people say, well, I just, what if I need the liquidity? Then we'll choose that. So we're going to match you up to the contractual guarantee that fits your situation and fits what you want to happen, in addition to the contractual guarantees that you're going to receive. So thank you for that, producer. All right. I'm 59. Wife is 57. Mainly want to make sure she has something simple if I'm not here, but would consider something for both. Is there an annuity for 2 people together? The first question I would ask you is, what do you want the money to contractually do? If you're talking about lifetime income, certainly we can do an immediate annuity or deferred income annuity. If you're talking about just protecting the principal, hey, Stan, we just don't want to touch the principal. We want it to always be there. We don't want to pay fees and just peel off interest, then that's a multi-year guarantee annuity is the best choice for you. So it really comes down to what you're trying to achieve. But yes, we can set it up so that, the spouse can continue the policy, whether it's IRA or non-IRA. We can do that. We can have that discussion. But I got a call the other day. Maybe this is what you're asking. If not, hang in there with me. The person said, I want to set something up for my wife so that when I die, it's going to replace an income stream that we have. But when I die, that income stream is kind of going away. In other words, they're saying, Stan, can we buy something now that will have an income stream in the future that we can turn on when I die? Yes, you can do that. That's either a deferred income annuity or that's an index annuity with an income rider. But what I told him to do is also consider and talk with your tax lawyer, estate planning lawyer, to put something in the trust that says, upon my demise, please buy Joyce, his wife, an immediate annuity to solve for this lifetime income amount gap that's going to happen when I die. And at that time, we'll go shop all immediate annuity companies for the highest contractual guarantee. So you could do it preemptively and know exactly to the penny what it's going to be now in the future, or you could keep your powder dry and then have the trust dictate that immediate annuity purchase at the time of your demise, and we could do a reverse engineer quote to solve for the contractual guarantee. Producer, can you pull up the site and show, let's go to the immediate annuity calculator, and I want to show what a reverse, like when I talk about reverse engineer quotes. So on our quotes, and there's 40 different ways to structure lifetime income. And we show 2, life only and life with cash refund, because that's primarily what people buy. If you want to get down in the weeds, we can go there as well. But see, right here, when you put in your name and Joe Smith, I like Joe Smith. That's good. I just want to show them. You can just go down to choose your calculation. So you could either do, I know how much monthly income I want to get, which is reverse engineer quote, which means, hey, we need $2,000 a month, or you go to the other one. I know the dollar amount. We have $200,000. What would that create? You could do it either way. I always tell people, use as little amount of money as possible with annuities to solve for the contractual guarantee, which brings, thank you, producer. We can go back to the main screen, which brings us back to the main point. Well, what about inflation, Stan? If any annuity agent or advisor says that they have an annuity that addresses inflation, they are flat out lying or they're stupid. One of the two. They're either a sociopath or they just believe that, whatever they're spewing out's the truth. Annuity companies have the big buildings for a reason. When you attach any type of increase to a policy, the annuity company severely and drastically lowers that initial payment to make up for that. And I don't think it's worth it. I just do not. You already own the best inflation annuity on the planet, which is Social Security. So, if you've purchased an annuity, I hope not from someone else, but if you did, and that person said it's going to adjust for inflation, you're going to find out that was a flat out lie, and you shouldn't talk to that person anymore because that was a flat out lie. But don't look for it. Don't go down the rabbit hole looking for that product that adjusts for inflation. It doesn't exist. Can we put a cost of living adjustment increase on a product like an immediate annuity, a deferred income annuity, that type of thing that increases by 3% every year or whatever you choose? Yes, but they're going to lower the payment. And anybody's pitching an index annuity saying that the index is going to increase the income with inflation. That might be true, but the income amount to start is lowered so much, it's not worth getting. So just, hey, if it sounds too good to be true, what? It is every single time. No exceptions with annuities. Next question. Thank you, Stan. You're welcome. Next question. Do you have any videos on structured settlement annuities? Let's talk about that for a second. And what Simon is talking about are secondary market annuities, SMAs. We do not sell them because they're very, very complex. And let me tell you why. When you buy a secondary market annuity, you're buying the rights to a payment. Currently, with the state attorneys general, that's attorney generals plural, there's a class action lawsuit from some of the beneficiaries that are claiming that the people that have bought the rights to the policy don't own the rights to the policy. It's kind of messy. But if you want to get in the weeds of that and talk about it, please schedule a call with me and we will discuss secondary market annuities, which are structured settlement annuities. But in essence, what happens if the person gets a structured settlement and the judge says, here's the annuity payment, what's happened, the reason that you can go buy the rights to that is that person goes back to the judge and says, I want to sell a portion of those payments to raise money, and that's what happens. And then you get to buy the rights to that payment. That's where the problem lies. I know you're going to hear from other people. It's not a problem. It is a problem, and the paperwork on that is huge. If you said to someone that's trying to sell you a secondary market annuity to send you the paperwork to review on, you would never buy it. It's like 90 pages. I remember when Leah, my CEO, and I looked at that space, and we got the policies in, they're not policies or rights to the payments. And we read it. We were just like, no, there's too many issues going forward. Has it worked for a lot of people? Yes, to buy secondary market annuities, but I just don't see the reason to try to chase that extra yield for a potential problem in the future. Okay. Next question. I'm wondering generally what you think of the TIAA traditional annuity. Okay. Payout rates seem high and happily for it. TIAA is kind of the granddaddy of annuities. It's been around for a long time. It used to be called TIAA CREF. Their annuities internally are good from a claims paying ability standpoint. Fantastic company. They can certainly back up the claim. What I will always tell people to do, though, if you're getting a quote from, say, TIAA or whatever other annuity company, and you have the contractual guarantee that they're quoting, life with cash refund or life only or life with 20 years certain, whatever it is, just shoot us that PDF and have us do a comparison quote. Now, the only caveat to TIAA is what we have found is moving the money from TIAA is somewhat limiting at times, depending on the type of account you have and the structure of that account and et cetera. There are times that we can't move it, and that's fine. But if we can, you should always be doing a comparison quote for the highest contractual guarantees out there. Okay. Victor, what do you think if I transfer my current 2 variable index annuities to Nationwide? Well, That's a loaded question. And to a fixed index annuity with a 1.2% total fee in order to get $500 more income per month, is this a good annuity? There's no annuity. We represent Nationwide, so nothing against them. We love them and every other company. But when you are looking to transfer an annuity, you cannot just make a decision on one annuity. You have to shop all carriers for the highest contractual guarantee for that specific situation. And it might be Nationwide, it might not be. Also, never, ever, ever, ever be convinced to transfer an annuity to another annuity because you're getting an upfront bonus. Never. That's stupid. I would want you to give us the opportunity to quote all carriers, including Nationwide, to show you who has the highest contractual guarantee out there. What if we could get you $650 a month per month, or $525 per month more? Same ratings. Annuities are commodity products. Do not become fixated on a specific carrier or a specific company or product that some agent or advisor says, well, this is the best one. No, there is no best one. So the other thing I want to point out, this is very important. So let's just say you have two annuities currently. When you transfer an annuity to another annuity, you have to go, we do this for you, but during the application process, we have to prove that the annuity that you're coming from and the annuity that you're going to, the one that you're going to is mathematically in your favor. In other words, the contractual guarantees are higher, not with hypotheticals and theoreticals, not with back-tested return scenarios or unicorns chasing the butterflies. We have to show that worst case scenario from the old annuity to the new annuity, the new annuity is better. Now, why am I pounding the table a little bit on that? If you have income riders attached to those previous annuities, you're not going to be able to transfer those valuations from the income rider to the new annuity. Why is that important? Because typically, 98 point whatever percent of the time, the income rider value is higher than the accumulation value. And that higher value does not transfer. The only way for an agent to get that through is to doctor the application, which is at least at a minimum a misdemeanor. But what we can do is look at what you have and look at the goals that you're trying to achieve, like when you want the income to start, run those quotes with all carriers, including Nationwide, and then prove to you that it's either mathematically in your favor to do that, to make that move, or not. Spoiler alert, most of the time it's not, because annuity companies have the big buildings for a reason. When they design these products, they make it difficult to transfer to another annuity to get a better contractual guarantee. I hope I'm being very clear about this, because these are some of the shenanigans that go on in the annuity industry that gives the industry a bad reputation. Transfer from here to here and get an upfront bonus. Transfer from here to here and the potential returns are going to be better. No, no, no. Buy an annuity for what it will do, not what it might do. Please do not sign that paperwork until we run a comparison quote with all carriers, okay? Do MIGAs have FDIC? No, FDIC insurance is for CDs and banks. MIGAs, all annuities, are backed up first and foremost by the full faith and credit by the issuing annuity company. But there is a state guarantee fund with each state that backs annuities up to a certain point. Each state is different. If you go to my site, we can give you that link. If you want to write it down, is nolhga.com. If you want to pull that up, producer, we can just kind of show them that. Can we do that? Are we that fancy? Maybe we are. I don't know.
We can. Just give me 1 second.
Oh, you're typing. Good. I get to drink coffee. Here we go. nolhga.com. The reason I think it's important to show it is I'm going to show you how to go look at your specific state. So yeah, here it is. I think I just saw it pull. Okay. If you scroll down, that's the main site. But if you scroll down under state associations and you hit click here on the right-hand side, this white box is third one down, hit click here. Okay. And then pull your state. Let's just say pull whatever, just pull one. Florida. Okay. And hit go. It'll take you to the Florida site. And then under FAQs, just hit FAQs. And every single one's going to have an FAQ. Your state's going to have an FAQ. And look under 6 or 7. Just look at those answers. Our policies cover what contracts are covered. There you go. So, for instance, Florida, $300,000 per contract owner is what's covered. That's the National Association of Life and Health Guarantee Associations, or whatever it is, NOLHGA. But I want to be very, very clear here. Listen to me. The state guarantee funds cannot be equated to FDIC. FDIC is the best coverage on the planet. Okay. Next question. I think that was it. Did he have a second question to that, producer? Have any MIGA companies gone bankrupt? In essence, absorbed by the state guarantee fund. The one that I can point to that has happened, 2008, was a company in Indiana that was absorbed in full by Guggenheim Life. After that, typically there's a lot of self-policing in the annuity industry because annuities are confidence products. So most of the time we see the bigger companies coming in and buying the smaller companies and the guarantees behind them. So we really don't see that. Annuity companies aren't smarter than banks. They're just more regulated. They can't do stupid things with your money. So next question. Your booklets and website talk about QLAGs. Let's talk about QLAGs for a second. First of all, they are a deferred income annuity. So deferred income annuity is a QLAG. QLAGs are deferred income annuity, but QLAGs can only be used in qualified accounts like traditional IRAs and now some retirement plans, but most of them are in traditional IRAs. Currently, at the time of this taping, you can use 25% of your total IRA assets or $145,000, whichever is less, and you can defer that income out to as far out as age 85. You don't have to go that far. And that $145,000 in this example is not used as part of your required minimum distribution calculations. It's a great strategy for future income. It's a great strategy to have income start in the future to hopefully address inflation with income starting in the future. It's also a good way to add a spouse as a joint payout person on that IRA so that they can get a lifetime income stream as well. But that's in essence what it is. It was designed and introduced in 2014 by the IRS and the Treasury Department. They designed it because they want people to plan for income in addition to Social Security. And this is their salvo into that. It's a great product. The downside of the product is that there's no growth component on it. You can structure it so that $145,000, if you die early, is going to go to your beneficiary, but it's not going to grow by like a percentage that you can track. What the annuity companies do is the longer you allow them to hold on to the money, the higher the payment. And we do have a QLAC calculator on our site. If you want to have a full conversation about that, we certainly can do that. But it is just think of it as another part of your income floor using IRA assets. It's a pension, and you can put your spouse on there as well. I think I dumbed it down. I think it was good, right? I mean, if you ask me to dumb it down, that's kind of a natural for me, right? Nod your head. Andy, in researching MIGAs, I see a 3-year offering 4.3% B++ rated in your state. We just have to have a conversation about that. Typically, if it's reached my site, there might be a couple of exceptions to that. Then we've done our due diligence on that specific carrier. Now, let me say this. When I do my analysis for recommendation for a MIGA, it's different from when I'm doing lifetime income. If I'm saying, okay, I recommend this carrier for lifetime income, we're marrying that company for as long as you're breathing. I have a different take on things then, okay? So there might be MIGA companies that I recommend to you for a 3-year duration that I would never recommend to you for lifetime income. I hope that makes sense. What my analysis of their financials and their bond holdings and their solvency ratios, and of course, I've done that in the past with my time at Morgan Stanley, and Dean Woodard, Payne Weber, UBS. I know how to do that. I'm looking at, can they back up the claim for 3 years? Do they have the money in place to do that so that after the 3 years you can move on? But I would just have to talk to you about a specific, the specific carrier you're talking about. I don't want to do that on this taping. We typically don't mention companies and then give analysis of that company just out of respect for them. But I will do that one-on-one with you. So next question. I'm 35. You should never buy an annuity, even if you're in Canada or US. First of all, we don't sell or have the capability or ability to sell to anyone in Canada. Thank you for joining us, but it just is what it is. But let's just say you were in the United States and you were 35. Under no circumstance should you ever buy an annuity, my opinion. I always tell people, unless you're 50 or above, you really shouldn't be looking at that. Are there some specific asterisks to that, one-off situations? Yes, there are, but in my opinion, if you're less than 50, you should be running the other way when someone says annuity, because that person's a sociopath if they're really trying to sell you one. Especially, I see this all the time, 20-year-olds and 30-year-olds and 40-year-olds buying index annuities. That is just dumb. That is stupid. And the person selling you that should lose their license, in my opinion. Next question. This is Ted. Looking further, I see that TIA changes payout rates for every year. Seems like they raised payout rates by 5% for all annuitants in 2022. This seems to be different from ASPIA. Once again, Ted, I would have to see the specific product that TIA is offering and just do an apples to apples comparison. But understand, the older you are, the higher the payment. It's that simple. Don't go in the weeds any more than that. It's just like Social Security. Are the payments higher at 70 compared to 65? Yes, because you're older, which means there's less projected payments, which means the payments will be higher. So it's nothing more, nothing less. So don't do any over analysis on that. Next question.
Stan, can you talk about how purchasing a lifetime income annuity can make someone a better investor?
Mm-hmm. I call it putting in an income floor. An income floor would be Social Security, a pension if you're so fortunate, dividend income, whatever's hitting your bank account. So if you said to me, hey, Stan, the wife and I, our floor, that nut we have to hit every single month is $6,000, and we're at $4,000. Then I would say, let's reverse engineer a quote to solve for $2,000 so that you're going to be at the $6,000 that's going to pay the bills and you can go live your life. Now, when you do that, what you're going to find is you're going to be a better investor because you do not have to disrupt your investments to pay the bills, which totally shoots down the 4% rule. A lot of you have been presented by your advisors, well, don't buy an annuity because we can just do 4%. We can just peel off 4%, have the money grow, and it'll all work out. Well, in these markets, that doesn't work out, okay? My opinion, you put the income floor in place, and then you go invest the rest and keep your powder dry. And if there is an inflation need, so let's just say in this example, the $6,000, you come back 2 years from now and say, you know what, we need an additional $250 for that income floor. Then we do a reverse engineer quote for $250, use as little money as possible to solve for that specific inflation need. Remember, inflation is not some pie in the sky thing that it's all things for all people. No, it's about you. It's about your specific situation, your specific income floor numbers, your specific needs, and let's solve for that. Yes, I know the media doesn't look at that like that, but it is like that. Give an example. My daughters are out of the house. I'm not buying as much milk and cereal and taking them dance lessons anymore. So I don't pay as much in gas. I don't pay as much in food. So inflation affects me differently. I want you to look at that for yourself as well, and don't get hung up on all of this talk from the media and the CNBCs and the Fox Businesses of the world. That's just inflation. Yes, if you're a truck driver, it's tough. If you run a long care service, it's tough. But if you're retired and you're not traveling that much, it's not as big of a deal. Yes, we all have to buy groceries, but most of us can't afford that. Not all, but most can. But it's not transitory, Miss Yellen. I think this one's here for a while. There's just no good answer to that. But from being a better investor, which is what Leah was talking about, what we have found, and people will call me all the time and say, these markets are crazy, but I'm so glad we have the income floor in place because I'm just watching it, or I'm buying specific things for better opportunities, etc. With that being said, let me just say this, and I want you to listen very clearly to me. Never, under any circumstance, buy any annuity type, regardless of the sales pitch for market growth. And if you do, you're a fool, or you've bought the sales pitch, because annuities are not market growth products. I know the industry disagrees with me on that. I know that carriers disagree with me on that. I know that agents and advisors disagree with me on that, but I'm right. I'm totally right about it. Because with any annuity product that anyone's pitching for market growth, there's limitations on choices, and there's limitations on a lot of times on upside. When you're investing in the market, there should be zero limitations, and that eliminates all annuity types. You buy an annuity for what it will do, not what it might do. That's the contractual guarantees. And if you don't need those contractual guarantees, if you don't need to transfer risk to solve for one of the four items that I list that annuities solve for, and the acronyms PIL: principal protection, income for life, legacy, long-term care, confinement care. If you do not need to contractually solve for one of those four items in that PIL, then you do not need an annuity. Do not buy an annuity for growth, period, and market growth. Okay. Thanks so much for all your insight. Last question I have, this is from Ted. Ted, ask me any question you want. This is a live event. Wondering if you are concerned with private equity companies buying annuity companies and reinsuring in Bermuda. The answer is yes. And what Ted is referring to, let me just kind of dumb that down a little bit, is with 10,000 baby boomers hitting age 65 every single day, it's a demographic tidal wave of people looking for products that provide guarantees. And obviously the smart money, the gurus, the master of the universe, the single malt scotch drinkers smoking a cigar, they want a part of that. So we're seeing a lot of private equity type money come in. A good friend of mine, Kerry Pector, who's been on my podcast, Fun with Annuities, we talked about this. He calls it the Bermuda Triangle effect of these companies, coming in and then parking your money in Bermuda. We are watching it closely. I'm working with some firms watching it closely. We're going to start addressing this in a big way, probably later this year in 2023. But I'm concerned about it. I mean, annuities are boring products. Anyone that says they're not or presents them as something else, then I don't know what they're doing. They're boring contractual products. I like boring. I like simple. I like when I can explain it to a 9-year-old, no offense to 9-year-olds. If you can't explain it to a 9-year-old, don't buy it. If someone pitches something and that you can't explain it, then don't buy it. But you have people now getting into the business that are not your typical stodgy, conservative person in the annuity industry. And it is a little concerning, and we are watching it closely. Definitely. Yeah. Next question. We're retired. Income from our pensions and Social Security is $60,000 more than our annual expenses. You said that everyone needs some exposure to the stock market. We would rather have nothing in stocks. Then my opinion, if that's the case, then you really have a couple of choices. There's really 5 places to go that protects the principal in full. Please do not argue with me on this. I'm right. CDs, money markets, AAA municipal bonds, treasuries, and fixed annuities, MYGAs. I'll do it again. CDs, money markets, AAA municipal bonds that are insured, treasuries, and fixed rate annuities, MYGAs. You also could throw index annuities in there because they're CD products as well, but they fall under that fixed annuity category. So if you don't want any exposure to the markets, then you need to do a combination of CDs and MYGAs, in my opinion. Just ladder CDs and ladder MYGAs. You protect the principal. You don't pay any fees. You get a guaranteed interest rate. Did that for a couple the other day that under the same premise that they really didn't need more income. They just didn't want to lose any money. And from a legacy standpoint, they wanted to leave all of that money intact to the beneficiaries, but yet they wanted access to the interest that earned. No brainer. CD, MYGA ladders all day long. I don't sell CDs, but that's the way to do it. Next question.
That is about it for questions.
That is about it for questions. Very nice. Listen, we're going to do this ongoing. I'm going to start bringing on guests, but I'm not going to tell you who they are until you get the email. But look out for that. I really appreciate you joining me. Look out for our podcast every Tuesday, Fun with Annuities. We put out content every single week. Go to my site, schedule a call, and I hope to see you soon. Thanks for joining me. Have a great day.